Over the last couple of weeks, some of America's biggest and best-known companies have announced sweeping layoffs. Amazon, Meta, and Twitter among the marquee tech names cutting back and raising red flags about potential trouble ahead for the rest of the economy. But could the slowdown be contained to Silicon Valley? NBC News business and data reporter Brian Chung looks deeper in our Sunday Focus.
Once high-flying companies with ambitious visions of the future, giants in the tech space are now in dramatic cost-cutting mode. The biggest, Meta, which announced this month it would lay off more than 11,000 of its employees.
I take full responsibility for this decision.
Amazon is reportedly prepared to let go of 10,000 of its employees, making it the largest cut in the company's history. Twitter, Peloton, and Snapchat, among other names, slashing over 1,000 workers each this year. It's a sharp turn for Silicon Valley, known for its insatiable demand for talent. And when the pandemic raised the prospect of being stuck at home for good, big tech got bigger on the vision of a post-pandemic world filled with stationary bikes,
a Peloton,
and work meetings in the metaverse.
Imagine if you could be at the office without the commute.
Companies now paring back as they underestimated the extent of the snapback to a pre-pandemic lifestyle.
They're still buying streaming services. They're still shopping online. That increases every year. It just isn't increasing at the rate that the companies thought it was going to based on what they were seeing in the pandemic.
Still, the tech industry makes up only a tiny sliver of the larger, more resilient labor market. Goldman Sachs estimates that even if the major social media companies evaporated entirely overnight, the layoffs would only raise the unemployment rate 0.3%.
We're looking at a 3.7% unemployment rate, broadly speaking, in the economy. That's pretty good. That's a workers' market. But is this a sign that things are starting to change?
It is still a very good time to be looking for a job. It is less good than it was 6 months ago, and it was less good than it was 6 months before that.
Things may get worse from here, too. Economists at the Federal Reserve say the unemployment rate could rise to about 4.4% by the end of next year. The reason? It's the potential cost of lowering inflation.
What we're seeing in the tech sector is likely not an indicator of an overall weakness in the labor market. But because of the Federal Reserve Board's actions to slow the economy, we do have the possibility that we will see a substantial slowdown in coming months.
The Fed has moved at the fastest pace in decades to raise interest rates this year to slow an economy with rapidly rising prices.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions.
Translation: higher operating costs and reduced spending from consumers could push employers to lay workers off. But with the economy still adding an average of 407,000 jobs each month this year, the big tech layoffs do not appear to be having a ripple effect.
I don't think the tech layoffs that we're seeing right now are an indicator that there's an impending recession.
The question is whether or not that changes in 2023.
And Brian joins me now live. Brian, good morning. So it sounds like economists generally do not necessarily believe the layoffs in the tech industry are a sign of trouble in the broader economy or even a recession, but they also don't exactly expect smooth sailing in the year ahead.
Not at all, Willie. But again, just to reiterate here, the economists that I spoke to emphasize that there's not necessarily a recession happening right now. It is the expectation that layoffs could increase as the Fed makes borrowing costs more expensive. That could push some businesses to scale back in how large they want to be, which could lead to some layoffs. But again, the unemployment rate right now at 3.7% is near 50-year lows. So even if there is indeed the concern of a recession, remember that means the economy in multiple factors having a downturn. So the inflation side, certainly not good. But at least for right now, the labor market not yet necessarily flashing signs of a recession, Willie.
We'll take that as some good news. Such a complicated story. You explained it well, Brian. Thanks so much. We appreciate it.
Hey, thanks for watching our YouTube channel. Find your favorite recipes, celebrity interviews, uplifting stories, shop our favorite deals, and so much more with the Today app. Download it now.